Can the insurance company lower the cap rate on your indexed universal life insurance policy? Hi, I'm Brandon, founder of the Insurance Pro Blog and co-host of the Insurance Pro Blog podcast. An indexed universal life insurance has an interesting selling proposition. It seems to suggest that you might get market-like returns without the risk of loss when the market goes south. But there is a limit to how well you can do with indexed universal life insurance. We generally call that a cap. The cap is a hard limit on the performance the policy can give you in terms of an interest rate in any given year. So for example, if you're following the S&P 500, which is the most common index option on indexed universal life insurance policies, you'll get whatever the change in the S&P 500 is up to some cap or some limit. If the S&P 500 is up 10% and your cap rate is 10%, it doesn't really matter. You're going to get a 10% interest rate. But if the S&P 500 is up 15% and your cap rate is 10%, 10% is all you're going to receive as an interest payment on your cash value. But further, your cap rate can change. It can go down. It can also go up. And the insurance company can absolutely make this change. But understanding how and why an insurance company would lower the cap rate is critical to understanding what indexed universal life insurance is all about. Because a number of people have a very warped impression of what indexed universal life insurance is trying to accomplish, and that sets them up for oftentimes disappointment. First, let's dispel a myth about what's going on in terms of profitability for the insurance company when it comes to the setting of the cap rate and the difference between that cap rate and where the S&P 500 or any index, for that matter, falls for the end of the year. There's a rumor that circulates around the internet that the insurance company is taking the difference between the cap rate and where the market falls for the year. In that example, when we had a cap rate of 10% and the S&P finished at 15%, the suggestion is that that 5% difference is going into the pocket of the insurance company. That is completely false. The insurance company does not profit from that difference. In fact, insurance regulation prohibits insurance companies from using financial derivatives for the sole purpose of creating investment profits. They can only use these financial instruments for the sake of hedging their other underlying investments or to create indexing features like what you find in an IUL or an indexed annuity. The strategy that insurance companies are primarily employing to create the indexing feature is what we would normally refer to as a collar. It creates a floor, the most you could possibly lose, which is generally set at 0, and a ceiling, which is what we typically call the cap. I am admittedly oversimplifying this process a bit, but for the sake of understanding the rest of this video, that is more than enough understanding to follow along. There are two primary variables that influence where the cap rate is going to fall. They are bond yields and volatility, or the pricing of the derivatives that will be used to create the indexing feature. When you pay premium to an indexed universal life insurance policy, the insurance company is taking the majority of that money and they're using it to buy bonds. The yield that is created from those bonds will then be part of a budget that buys the derivatives that will be necessary to create the collar that I previously mentioned, which is the driver of the indexing feature. Yield matters because it determines how much money will be left to pursue the building of that collar. But pricing of those underlying assets, primarily options, but there are a few others that may be used, also dictates where the ceiling is going to fall, because as prices go up, the money that's in the budget to buy them obviously is going to go less far. The critical thing to understand in all of this is higher bond yields and lower volatility creates a circumstance where cap rates can go up or be set at higher levels because there's more money created by the bonds to actually pursue the collar, and the price of the assets that need to be purchased for that collar have declined. But the inverse is also true. If bond yields go down and volatility goes up, that creates downward pressure on cap rates and will absolutely, in most cases, cause them to go down. Now, in more recent history, the 2010s primarily, we saw a circumstance where interest rates declined and stayed very low, and volatility had moments of high and low periods. This averaged out to an economic reality that for the most part pushed cap rates down on indexing products across the board. But that rise in bond yields definitely set the circumstances for the ability to increase cap rates, and we saw that happen with indexed universal life insurance and fixed indexed annuity products. But not every insurance company did this universally, and that raises an interesting question. How come we see some companies raise their cap rates or reduce their cap rates, but not others? They are theoretically all functioning in the same economic environment, so what causes one company to reduce their cap rate while others stay where they are? The answer to this is that most insurance companies do not themselves execute the collar strategy that ultimately creates the index feature of an indexed universal life insurance policy or a fixed indexed annuity. Instead, they rely on the sophistication and expertise of a third party to create an investment vehicle that they will then use to create the indexing feature. When you yourself don't have full control over the composition of this strategy, you don't get to control exactly where the cap rates are set. And there is a small amount of risk that the cap rate that gets set for the year won't actually materialize with the underlying investment, depending on how it's put together. Some insurance companies are more willing to shoulder this risk and cover this difference if need be than others. There are also a few number of insurance companies that do take care of the entire collar strategy in-house. They have much more control over where the cap rate gets set. They typically have slightly higher cap rates than the rest of their competition, and they generally move those cap rates much more infrequently than the rest of their competition. Now, all of this speaks to a very important element of indexed universal life insurance when it comes to what style product it is and where your expectations should lie. The product is much more closely related to bonds than it is stocks. So if you're buying indexed universal life insurance with the expectation that you're going to achieve market-like returns without the risk of loss, you're setting yourself up for colossal disappointment. If instead you look at indexed universal life insurance as a fixed interest, bond-like asset that has a little unique feature that will potentially give it a higher rate of return in several years, now you're focused on the right thing, setting the correct expectations. Historically, indexed universal life insurance has been a safe style asset that has slightly outperformed the performance we've seen from something like whole life insurance. But it has by no means rivaled the rate of return achieved on stocks. And it never will. This is important to understand because some people get lost in the comparison of what indexed universal life insurance is doing cap rate wise relative to something like the broader market, the S&P 500, for example. If your cap rate is sitting at 10% and the S&P 500 is up 30% for the year, it looks like you made a really, really bad decision buying indexed universal life insurance. But if you keep in mind why you own it, why you should own it, because it is a fixed rate style asset, that 11% or 10% or whatever it is cap rate result, it's going to look mighty great up against the 4 to 5% interest rate that you typically get among other appropriately compared assets. So keep in mind that higher potential rate of return, like what you can get with stocks, is a great thing that you should absolutely have exposure to, but you're never going to eliminate the risk of loss when setting yourself up for the realistic return expectations that stocks would have. If you're interested in knowing more about the good and bad of indexed universal life insurance, we have a podcast that we released just a couple weeks ago that'll link to the description below. And if you'd like to know more about working with us to custom design a life insurance policy for you, there's a link below to get you started on that as well. Thanks for joining me today, and I'll see you next time.